Welcome to the all-new GenWealth Radio Hour, and if you're watching online, welcome in for the next 45 minutes to a couple of different paths to talking about financial matters. My name is Scott Inman, along with me, GenWealth co-founder Janet Walker, and Janet is in the chair for the first time since our new format was created. I know you're excited about today for many reasons, but
we got a spicy topic to talk about. Yeah.
We do. So if you're new to the show, or if you have been a long-time viewer or listener to the radio hour, but you haven't listened or watched lately, we have created this new format where the first segment of our show is about current events and basically stuff that may be trending on social media, or maybe it's news that has recently happened in the financial markets, or maybe even externally from that. And we're going to kick our opinions, we're going to let those opinions drop and then kind of kick our responses around to that, maybe poke holes in it, maybe agree with things. And honestly, for the first this is the third week that we've done it, for the first couple of segments that we've gone through, we've been mostly in agreement with what has been posted or what we've been talking about. Today, that's going to change. I can tell you that Janet, maybe even more so than me, is a little more riled up about this. The real problem with social media and taking any kind of advice, or really even getting any kind of action steps off of that, especially financial ones, is it's taken in such a vacuum. It's put in bite-sized pieces, and that's how it has to be for people to pay attention to it. I get it. Our attention spans are getting less and less, and I've already spoken out just now longer than most social media posts, right? But you can't really develop a good, sound strategy or even make financial decisions based on that.
You can tell somebody how to make sourdough bread on social media. You cannot tell somebody about what their Social Security claiming strategy would be on social media. That's it. So there you go. You already know the topic that we're going to, but I'll hand it back to you, Scott.
That hasn't stopped people from trying, right?
That's true.
So there was this, it said it's a viral video. Now, I didn't double check that, and I don't even know what qualifies as
that,
viral. I don't know if it's 1 million views. I don't know what it is, but there's a video out there from a CFP, certified financial planner, saying that taking Social Security at 62, which is the earliest you can take it, is a no-brainer. And we've got that video for you. So we're going to let you see it or hear it if you're listening on radio right now.
Taking Social Security at 62 is a no-brainer for these 3 reasons coming from a CFP. First, break-even age. Log into SSA Gov to see your personal payout options. Here are mine. If I add up all the payments, I wouldn't break even by waiting to full retirement age until I'm 79 years old, and the average American dies at 78. 2, if I don't need the money, I'll invest it, even with a modest 7% return. I wouldn't break even until I'm 115 years old. Only 3 Americans in history have lived that long. And 3, Social Security solvency issues. Social Security's own website says benefits will be reduced by 20%, starting in 2034 without major policy changes. Are you betting on politicians balancing the budget? And a bonus to clear up the most common misconception. If you're still working at 62, your payment will get reduced, but it's not lost. The amount withheld gets repaid back to you at full retirement age. For those 3 reasons, I'm taking Social Security at 62. How about you?
I love these walking and talking videos where you got your mug and you're just, it's like you're just kind of discussing in your head. And I mean, there's a lot wrong with this in our opinion. So we're going to kind of break that down over the next few minutes. First of all, making a decision universally or telling people to make a decision universally, I think is problematic to start.
So I'm just going to go to town on this. Scott, you may not get the microphone back for the entire show. Here we go. Okay. So I'm just going to say the only no-brainer thing about this whole deal is not the decision, it's the guy talking, because he did not use his brain to think through this. And let me say respectfully to those who are CFPs, I do not have a problem with CFPs. I have a ton of respect for what they go through in that process. This guy is not honoring the rest of the CFP world in the approach that he's taking here. So let's just take a few topics here. So the first thing that came to mind when he said this, he says only 3 Americans have ever lived to 115. I'm not even basing the reason for not taking his advice on this, but this is not accurate. 79 people, only 3 of them were men. 79 people have made it to age 115, but only 3 were men, which causes me to question, is he looking at this? He said only 3 Americans, but it's really only 3 men. Is he looking at this just from a man's perspective? And if that is the case, let's keep talking about the age for just a minute, and then we're going to talk about spouses. The age, he says the average American dies at age 78. Well, y'all, I had a brother who passed away at age 11. He's in those averages. We look at average ages and think that's when we're going to die. Not the case. You have to think about how many people didn't even make it to adulthood. They are included in the averages. You cannot do any financial planning decisions at all based on averages. It's dumb. Okay? We're not going to do that. But also, thinking about it from the spouse's perspective, I did notice that he's wearing a wedding ring. I want to know if his wife understands what he's thinking about Social Security. Because here's the deal. For people who are close enough to Social Security claiming age, most of the time, the guy is the larger earner between the husband and wife, okay? And most of the time, we are dealing with couples, not singles. If we're talking about a single individual, the math that he did is right. The ages are not, but the math that he did is right. But we're usually talking to couples. And so we want to look at what is in the best interest of the husband and wife together. I'll say in my family, I'm actually the higher income earner, so I'm not trying to stereotype here, but statistically speaking, it is accurate to say that in the generation that is either already taking Social Security or about to be, most of the time the guy is the higher earner. So if this guy wants to look at an individual male, okay, maybe. But most of the time we're talking about couples, and what we want to look at is when the guy goes first, which he usually does. By the way, that's why 76 of the 79 people who've made it to 115 are women. So when the guy goes first, the wife still needs income, and the smaller of the 2 checks goes away. Why on God's green earth, if you love your wife, would you take your higher Social Security check at age 62 instead of continuing to get an increase every year that you can delay it? When we have the opportunity to delay the check for the higher income earner until age 70, we do it. That is not always the advice, because we want to look at an individual situation and pay attention to the individual people, which this guy is not doing. He's saying it's a no-brainer to just take it at 62. You have to look at your household. If we delay that check for the husband until age 70, if he's the higher income earner, then that means when he passes away, then her, as a surviving spouse, her income will be higher than if he had taken his Social Security check at 62. Period. No ifs, ands, or buts about it. So if you love your wife, your spouse, you need to pay attention to this. It needs to be a household strategy. Let me talk about CFP. He's touting this is from a CFP, implying that means that it should be gospel truth. A CFP, sir, has a duty of loyalty and a duty of care. So let's talk about that for just a minute. Under your duty of care, you are to act with skill and diligence and to review relevant information. And if you have ever in your history as a CFP done a Social Security analysis, you will see that right after you put in the name and the date of birth, usually the very next thing they ask you is whether or not they're married, because it matters. So if you're going to tout that you're a CFP, let's actually act like one and use care and loyalty to the client to be sure that you are taking care of both the husband and wife. I'm going to take a breath. I've still got more, but you can take your turn, Scott.
We spent way too much on that mic for me to tell you to drop it.
My
But
gosh.
that was a mic drop moment. I'll take a couple of other things that because he talked about a lot in there.
He did.
And the one final bow on the break-even age argument too. You were talking about the life expectancy of 78, and you talked about your brother. And the other piece is that is from birth. The life expectancy of 78 is from birth. Another stat I'd throw back at that is that if you are age 65 today, and you're a 65-year-old couple today,
Yep.
there is a 50% chance that one of you will live to age 90 because you take out all those mortality rates,
Yeah.
of early deaths. And if you've made it that far, you're likely going to make it farther than 78, statistically speaking.
My mom is 85, and she says every time she hears this average age stuff, she just looks at me. She was a math teacher, so she likes averages and that kind of thing. She just looks at me and says, I figure I'm using somebody else's years because I'm above average.
That's exactly right. It's a good piece to say. And the other thing, too, he talks about solvency concerns, and that is accurate. So the fact is accurate that by 2035, the trust fund may only cover 80% of scheduled benefits. And, he argues, are you going to trust the government to balance the budget? And the truth is, no, I don't trust the government to balance the budget, but I do trust the government or the politicians in office to do what it takes to get reelected. And I do not think, I would say it's a less than 1% chance that at 2035 that actually happens, because they're going to make the change as necessary to keep it going. And if they do cut benefits, I believe it would be for younger generations. They'll raise the retirement age for somebody in their 20s or 30s today, but they are not going to mess with the seniors taking benefits currently in 2035, or they're not going to get reelected.
Those of us with gray hair vote, and that is absolutely the case. And even if he's right, and I'm in complete alignment, Scott, with you on what you've said and not with this guy on this, but even if he's right, do you want 80% of a smaller check or 80% of a larger check? You need to consider that as well. But the other thing that he didn't even bring into the conversation, because this is a fear play, Scott. It's like, this is going to, be reduced to 80%, and so you need to make your decision based on the fact that that's going to happen. It's a fear play. Let's also maybe look at the facts. Might be important to do that. So if you think about historically, when Social Security was started, it was age 65 when you would start claiming. The highest, the full retirement age was age 65. That has increased to age 67. And you see what's happening with RMDs. Those are being bumped farther out because life expectancy is growing. And so he's not thinking about the fact that Washington has already saved Social Security before. They have done it by expanding that full retirement age and kicking it farther out down the line. I believe that they will do that in the future. There are also other opportunities. They can continue to increase the amount that is contributed to Social Security instead of having caps on earnings where, once you pass a certain threshold, you're no longer contributing. There are lots of ways that they can salvage this in order to, as you said, Scott, get reelected.
Yeah. And the other thing that he said there at the very end, I think, was interesting as well, because we do talk a lot about this in the client meeting room, that if you are going to continue to work past age 62, it doesn't really make sense to likely take your benefit at 62 years old. And the reason being is there is an earnings limit, how much income you can earn if you are receiving your benefit prior to full retirement age. In 2025, that is $23,400. So if you turn your benefit on at 62, like this guy says, no matter what, it's a no-brainer, turn it on at 62, and you continue to work and you make over $23,400, Social Security will deduct $1 from your benefit for every $2 over that limit that you earn. So if you're going to make $100,000, you're not getting much of a benefit. Now, he is right that when you reach full retirement age, they do return that money to you. So it is not lost forever, but they're not going to give it to you in a lump sum. They're going to use a very complicated calculation to return it to raise your benefit when you get there to full retirement age, so that over time you would recoup that money. But here's the issue. If you don't live a long life, because again, we've been talking about living a long life, but if you don't live a long life and you die sooner, then you're not going to get all of that money back, and it's not clean. I mean, why in the world would you take 62, start taking your benefit if you're still earning a living? You likely don't need it, and he throws the piece out there that you can invest it, but I don't know anybody that really consistently has ever probably done that. They might do it for a little while, and then they're going to get used to taking the money and spending it. So that's not likely a realistic thing, and I think that we generally do encourage people not to take it early if they are still working. Now, we're not we're not an opponent of taking it early.
No, not
I want
at
to say
all.
that too, but it depends on a person's plan.
Well, and the reason I got so just riled up about this is, let me say, if a client came in and said, "Hey, I think I need to take this at 62," the conversation would have a completely different tone. This guy is saying, "I'm a CFP, and it's a no-brainer for everybody to do that." And that gets me riled up because he's going to cause people to make a mistake that it is not in their best interest to go that route. So know that, you come in, you got a question, we're going to walk through it, and we're going to be able to go through the numbers for your situation. He was making a global statement that I think even globally is not logical, but it's certainly not right for all people.
I think you could count on one hand the number of things you could say that everybody should do, right?
Financially,
you should save for retirement. You should invest for your future. But past that, I mean, it's not wise to throw everybody into one lump pile of you should always do this or you should always avoid that.
Right.
And that's, I think, what catches our eye before we watch the video when we see the headline that it's a no-brainer. Well, wait a minute. You got to use your brain. Like you said at the beginning of this, you got to use your brain and apply it to specifically your situation and determine the Social Security claiming strategy that's right for you. So, man, we put a lot of topics in front of us that we may potentially go over during this segment. And here we are in week 3, and we didn't get past the first one.
Well, that was a solid topic.
It was very good, and I appreciate our marketing team for finding that, giving us a heads up that was out there. So hope that made sense for you, and that's going to do it for our What's Happening segment. Go ahead.
Well, so if you're out there and you have Social Security decisions looming before you, and you don't want to take the, air quotes here, no-brainer decision that this guy was talking about, if you'd like something that, I don't know, is maybe personalized for your situation, then you can reach out to us. Lots of ways to do that. GetReadyForTheFuture.com. You can find out more about us there. You can call us at 866-653-PLAN, 866-653-PLAN, which is 7526.
The Get Ready for the Future show answering your questions is next.
You've been sold the idea that financial independence is all about some number on your account statement, or even worse, that you don't qualify because of where you started out. That's just not true. It's not about some well-kept secret of the wealthy. It's about finding the right information and knowing how to apply it. On the Get Ready for the Future show, we're answering your questions so you can start making real financial change today. The journey to true financial independence begins right here, and it starts with you.
Helping people discover, protect, and share true financial independence. This is the Get Ready for the Future show. Glad to have you along where we're answering your questions once again for the next half hour or so. My name is Scott Inman, along with me, GenWealth co-founder Janet Walker. And we've got some good questions again today. Janet, we're going to dive right in if you're ready to go.
Absolutely.
First up today, it's Lewis from Arkadelphia. I'm 64 and financially ready to retire, but I can't bring myself to stop working. How do you know when it's really time to step away? So when the numbers say go, but your heart says not yet, it is time to rethink what retirement really means. So let's talk through that. I never want to take anything as a given in any of our questions from our viewers or listeners. So Lewis says he's financially ready to retire. I would say first up, I'd really encourage you to know that you know. You say you're financially retired, but have you created a retirement income plan that maps out your monthly income from all of your income sources like Social Security, pension if you have one, and investments? Do you know how much you can safely withdraw from your investments and not run out of money? And does your plan, if you have that, build in raises throughout retirement? And do you have a diversified investment strategy and withdrawal strategy that can avoid sequence of return risk? How you're invested matters here, Lewis. It's not just the number. It's not just if you have $1 million, you have 1.5, and you think you're financially ready to retire. It's how you structure those withdrawals. Sequence of return risk is if you are selling investments as they are going down in value. So if you're mostly or all in the stock market and you sell something as we enter a bear market as opposed to going up in the stock market, it could severely be a detriment to your chances of not running out of money before you run out of time. So I don't want to just assume that. And do you have a plan for health care, the costs of health care above and beyond what Medicare covers, and the potential need for long-term care coverage as well? So there's a lot to consider there. I don't want to assume that Lewis has done all of that. And if you think you're financially ready just because you hit a milestone in your 401k, that's not enough. A 401k statement is not a plan. So I would encourage you to build a retirement income plan. We can do that here at GenWealth. You can reach out and call us, 866-653-PLAN, 866-653-7526 to get started. But let's move on past that, Janet, and take on the piece of if he is indeed financially ready to retire, but he can't bring himself to stop working.
So, Lewis, I would absolutely concur with everything that Scott has said about making sure financially that you're on track. Beyond that, I would question you and ask you, you say, I just can't bring myself to stop working. I think you have to ask yourself why that's the case. Is it that you really love what you do? Is it that you have a fear about, like, I think I'm ready, but am I really ready financially? Is it that you need something to take your time and your attention and your passions? Like, what is the reason that you feel like you just can't walk away? We talk about the GenWealth Ready to Retire process, and a significant portion of being ready to retire is that financial aspect. And at age 64, we want you to be financially ready to retire. But you'll notice it doesn't say the GenWealth Forced to Retire process. You know, like, just because you're financially ready does not mean that you have to. So you've got to go through this kind of like self-analysis process and determine, like, why do I feel like I can't walk away? I will tell you that my business partner, John Shrewsbury, we joke about, you know, one day we're just going to have to wheel him out. He's going to be here for his last breath because he loves what he does. And I would also say, like, do you have something to retire to? You know, if you feel like you need to leave but you're not ready, you've got to find some passion, some purpose outside of work. And Scott, I think this is particularly true for men, that most men, whether intentionally or not, most men define themselves by what they do for a living. And I'll never forget, many years ago in my career, I was sitting with a husband and wife, and the husband had a job that when somebody goes, hey, what do you do for a living? Everybody goes, oh, you know, like it got people's attention. And
is he an astronaut?
Yeah, no. I don't really want to say, because I think it would maybe give away his
gotcha.
identity. But
Fair.
anyway, she looked at him and she said, you need to understand, nobody ever asks you what you used to do.
Yeah,
like,
right.
When you're retired, you're retired. Yeah. And so, Lewis, I would challenge you to determine what your identity is beyond your job.
Yeah, I think that's a big piece. It is an identity for us, and losing that identity, you have to have another one to step into. You know? And I think the piece here too, I think what you said was great, that it is not forced to retire. It is ready to retire. It may not mean, though, Lewis, that you have to work full-time. Have you explored the thought of working part-time, either at your current position, in your current career in a different role, or maybe stepping out and doing something that you've always wanted to do, but not really done it because you didn't think you could support yourself financially, right? Or support your family maybe financially. I think the work-tirement, as John has coined it over the years, is a great option for people too. You may be financially ready. You may not need to earn any more with a paycheck, but you may not be willing to give that up. There's volunteer places you could get plugged into there. It's a time spend thing more than it really is anything. I've had that thought process for myself. And I've said before here on the show that I have my own plan for financial independence, just like we do for our clients. I know when that date's going to be. I don't plan to fully retire. I will still work with clients here at GenWealth past that point. But a lot of what has helped me reach that conclusion is I don't have a lot of hobbies. I don't have a lot of time spent that I would go to if I wasn't coming here. And so that's one of the things that keeps me moving too.
Yeah, absolutely. One of the things we see change, and this might change for you in the future, is as you have grandkids and you go, okay,
That's
well,
true.
that is a time
Yes.
spend. But for some people, it's not. They're like, look, I'm going to see them on Friday night and I'm good, you know. But for other people, that is their time spend, 5 days a week. So whatever, you've really got to take some time, Lewis, to get to know yourself. And And I would also say, I'll look at this from a couple's perspective. Lewis, if you're married, how much more time do you want to be able to spend with your wife? And you may laugh at that and go, I get all the time I need. Or you may go, I really want more, because we see one of the gifts of being a financial advisor for decades is you see relatively young couples come in and you work with them year after year after year. And what you see in healthy marriages is that they value and love each other more over time than you did when you first met them. And there comes a time when just one of them comes in because the other one is gone. And oh my goodness, how much they wish they could have more time with their spouse. And maybe, given the opportunity, they would have retired sooner. So think through that as just another emotional aspect of the retirement decision.
Yeah, I hope we gave you some tidbits there to chew on, Lewis. And certainly if you're ready to walk into retirement and need to maybe solidify that you know that you're financially ready, certainly reach out and start a relationship with a financial advisor. We can do that for you here at GenWealth. And if you want more free info about retirement, investments, and your money, you can subscribe to our YouTube channel. Just go onto YouTube and search GenWealth Financial Advisors. For our live stream audience, they've already figured out how to do that, but you can also see past Get Ready for the Future shows on the YouTube channel as well. Our next question is from Walter via email. I'm 60 and feel paralyzed every time the market drops. I've missed several rebounds because I waited too long. How do I stop letting fear run my portfolio? Well, fear is a terrible investment advisor. If anxiety is keeping you on the sidelines, here's how to get your mindset and your money back on track. I sat with a potential new client just this week, in fact, that had gotten out of the market in 2008 and never gotten back in.
17 years.
Yeah, and that's the first time in a while that I've heard that. You back up 7, 8, 9 years ago, that was more common. But as the farther we get away from the great financial crisis, it's uncommon. But stepping away really cost her thousands, if not even over $1 million because of the market growth that you've missed. And Walter, if you are trying to time the market or if you're just trying to get out because of fear, it is going to cost you. We are all emotional about our money and investments. I'm emotional about my own, but some investors tolerate risk much better than others. One of the best things you can do, though, to manage your emotions is hire an objective third party. And Walter, I think that goes back to the first piece here that we talked about with Lewis, is getting a financial advisor that you can work with to help you better understand your investments, the risk tolerance that fits you, and the volatility that should be expected if you invest in stocks. Now, that's not going to solve all your fear problems, but it can certainly help.
Yeah, absolutely. It can make a tremendous difference. Let's look at what is the probability. When you look at S&P 500, probability of positive returns, this chart we're going to show you here is from 1950 to 2024, and it breaks this down over rolling periods, 1 year, 3 years, 5 years, 10 years, 15 years, the probability of positive returns. And if you look at a 15-year time period, Scott, you just mentioned the lady who came in who has been out of the market since 2008, 100% of the 15-year time periods in the S&P have been positive. 100% of the time in this 74-year time period that we're looking at. So I think people think a couple of things. They think that short-term returns are permanent, and they also think of their investments as the S&P 500. That is one thing that if I had a magic wand to change the way that people think on a topic financially, this would be one of the ones on my list, to help people understand that your portfolio, your investments, it is different than the market. Yep. You know, when people talk about the market, they're usually talking about the S&P 500. If you are a client of GenWealth, you have a portion of your portfolio that is reflective of the S&P 500, but you have a significant portion of your portfolio that is not at all reflective of the S&P. So I would encourage you, just think about, again, no direction of the market is permanent, and it is the fear of this permanent downturn that you're probably really concerned about. But also being able to segment those assets where a portion of your money is exposed to the risk of things like the S&P 500, but a very significant portion of it is not. So, Scott, we use a bucketing strategy for that.
So that's the other piece to it is with noting his age, I think that's a big piece of this too. At 60 years old, it gets even more fearful to endure a market drop. I've had clients come in that have gone mostly or all to cash because of their age, not because they're necessarily fearful of a market drop every day in the market. They're just fearful of what it would do to damage their portfolio at the time that they are walking into retirement. Well, here's the deal. With the bucketing strategy, you start to piece that out in terms of how much not only is allocated to equities, but the piece that would get damaged by a market downturn is a piece for our video audience you can see that is in a growth bucket that is not meant for income for quite some time. In fact, it would be in the neighborhood of 15 years, quite frankly, because of that stat that we put up there, that over a 15-year rolling period in the S&P 500, that it has never been negative. So we're putting faith in the equity market in the future that any short-term volatility or short-term bear market is going to work itself out over a 15-year period of time. So yes, your overall account value may dip, not as much as Janet has already talked about as the S&P 500 would in a bear market because you're not allocated fully to the stock market. But those conservative investments for the early buckets will be bringing you current income, and that will avoid sequence risk that we talked about earlier in the show as well, so that you can count on your monthly income being consistent. But we have to also count on those growth buckets because we're going to need to raise that monthly income over time so that you can keep up with the rising cost of goods and services. So I think that does provide some good, having that in a written plan and working with a financial advisor has that effect of a calming emotional effect on a client because the fear on what they're focused on is redirected to their plan.
Well, I have said for years that education is the antidote to fear in most cases. And so if you are concerned about what are my investments going to look like, what is my retirement income going to look like, get some education on not just retirement in general, but your retirement and your income plan. If you understand how that will work in good markets and bad, because we are not sitting here saying it's all going to be sunshine and roses. It's not. There will be times when it fluctuates, but if we know that ahead of time and we are intentional in how we plan, we're good.
Walter, we're going to name your question the question of the week. And why that matters is you're going to get a Get Ready for the Future Show tumbler, very much like the one I'm holding here on the set. All we need for you to do is to email us and claim it. Just send it to show@getreadyforthefuture.com. And if you'd like to get one of these nice tumblers, send in a question. It might be named the question of the week next week. Here's how you do it. 501-381-5228. That number again is 501-381-5228. You can text us a question to that number. You can also call it and leave a voicemail. We might use your voicemail on the air. We want to hear from you and anything that is on your mind financially speaking, whether it's retirement, Social Security, if you've got a question about that, how to take your pension, what to do with your 401k after you retire. All kinds of questions you could ask. Doesn't matter what it is. Send it in to us. We'll get it on the air. Just like we're doing with Carrie now from Little Rock. I'm 63 and just retired. I'm holding off on Social Security until 67. What's the best way to generate income in those 4 years without draining my retirement accounts too fast? You've hit retirement, so Social Security, you haven't turned it on. Here's how to bridge the gap without burning through your savings. I think the first question we would ask, Carrie, is why are you waiting? That matters, right? You need to evaluate if this is the best choice and not just because you want to. Choosing when to begin the process is key here. And the Social Security that decision should not be made in a vacuum. I know we talk about, we always bring it back to the plan, but it is the truth here. The Ready to Retire process, building that plan, we're going to analyze your options and recommend a claiming strategy that works best for your overall retirement income plan. It may make sense to go ahead and begin it now, because it could take some pressure off of your retirement assets.
Scott, I want to take some time, though, to talk about just a misperception that I think is very common about Social Security. We all get those statements about Social Security, like when we can take the income, what the amount would be at age 62, at your full retirement age, which for Carrie is 67, and then at age 70, it'll give you those breakdowns on each time period. But what a lot of people don't realize, you can take it at any point and it's different every single month. Like 66 and 6 months is different than 66 and 7 months and 66 and 8 months. It changes literally every month. And so, Carrie, as Scott has said, I think it's critical for this to be part of your overall retirement plan, that you're very intentional about getting the numbers that are specific to your situation. And if we need to, in any given year, if we need to turn on income for you in February instead of in March of the following year, okay, fine, we can do that. But you need to understand you're not limited to age 67 because your statement has age 67 as a choice.
Yeah, and I think it's important to know, too, what your retirement assets look like, because I think if you are what we would call a constrained investor, which is not necessarily just the amount of your assets, but it is the amount of your assets relative to your income needs and wants. So building that income plan, we can tell you, okay, this is the amount of monthly income that you want, and this is what you have saved for retirement to produce that. It may make sense, if that's tight, to be able to go ahead and turn Social Security on to take pressure off of those retirement assets. If you have it in abundance and you have maybe overfunded retirement, I'm always hesitant to say overfunded retirement because you really can't, but relative to your income needs, you may have more assets than you need to make the income plan happen, right? If you've got that, then you may want to delay Social Security. There may be reasons you need to delay that check, but we need to talk to you and work through that and look at your circumstances individually to determine the Social Security strategy that's best for you.
One of the other factors is whether or not Carrie is married and whether or not she was the higher income earner. So if you were the higher income earner and you are married, you may want to delay it even past 67. But again, we need to solve for where does your income come from if you're going to wait for that. And if you are not married, then that's not a factor for you. Some people, Scott, will choose to take their Social Security earlier in order to utilize those assets instead of their investment assets, because their investment assets can be inherited and that can be a legacy for their heirs, where the Social Security benefits obviously cannot. So there are so many variables at play here for you, Carrie, that I would circle back to. Again, I think it's very important. This is a six-figure decision. Most people don't look at it that way. They look at it as the monthly amount, and that is the value of the decision. But it is highly likely, Carrie, that over your lifetime that you will receive six figures in income from Social Security. Therefore, this is a very important decision, and I think it's important for you to sit down with somebody to walk you through a Social Security analysis that ties in with the rest of your plan.
We have recently started an extension of our services, since you bring up the inherited piece to that too. We now offer estate planning services here at GenWealth. We've got an in-house estate planning specialist. You can reach out today to book your consultation if you need to create some estate planning as a part of your overall plan too. You can do that by calling 866-653-PLAN. It's 866-653-7526. Our last question, just a few minutes left for Eric in Fayetteville. Our daughter is 28 and still needs help with rent occasionally. We're both 60 and trying to stay on track for retirement. How do we know when to say no? You want to help your kids, everybody does, but at what cost to your own future? Let's talk about setting financial boundaries without guilt. Well, first, you have to take care of yourself first, and that may sound selfish, but it's not. If you don't, your daughter will have to take care of you later. So if she's struggling now and needs help and you are helping her at the detriment to your own financial independence, guess who's left holding the bag and is going to be really struggling even more potentially to financially support you later. So there was a recent article that we had looked at earlier that said a full-time job isn't enough to afford rent anywhere in America. Now, I don't want to downplay the difficulty in finding affordable housing, especially in higher cost of living states in this country. But the Post claims that working 40 hours a week still isn't enough to afford a modest 2-bedroom rental in any state in the United States. And I didn't believe that, so I dug into it a little bit more. Well, guess what? That is using minimum wage, okay? So I don't know how much your daughter makes at 28 years old. And I know there are a lot of people that make minimum wage, and they may make minimum wage for a long time. When you think about the federal minimum wage of $7.25 an hour, then yeah, absolutely. A 2-bedroom rental is not affordable. What the article does say is you need about $33.63 an hour to afford an average modest 2-bedroom rental. And I think that varies, depends on where you live. But sure. I use that to say, if your daughter can't afford rent, if you take a look at the financials on what she's earning, if she is working, how much is she earning, then she needs to reevaluate where she lives. That's the bottom line here. So can she find a more affordable place? I don't know where she lives, if she lives in Fayetteville or if she lives somewhere else. Or could she save money by moving back in with you? Now,
or having a roommate.
Or having a roommate. There's a lot of ways you can cut that piece down as opposed to you just helping occasionally with rent.
Yeah, and I'll be real transparent about, in my personal family, we have a son who is 22 and is in, just the pace of life that people expect. I'm not going to say he's behind for him, but he's got peers who are ahead of him because he has Asperger's. And so it's just a slower pace of life to get to adulting, if you will. But what we are doing with him, he lives in our home and he is working, and we are making him pay rent. And it is not because we need the income to make the house payment. We were making the house payment before he was paying rent. It's fine. It is for him to have the discipline of doing that so that when he is on his own, then he has that responsibility. Now, you don't have to do this, but we're actually going to save the money and it'll turn around and go back to him at some point in the future. So, like, it can be a down payment on a house, that type of thing. But I would say I'm completely in agreement with you, Scott. If she's 28, if moving back home would not destroy your family, then have her do that and she pays you rent. Not as much rent as she would be paying at an apartment, but it's not dirt cheap either. Our son pays us $700 a month to live in the house that he used to live in for free, but he has to develop those life habits. So I share that with you, Eric, to let you know I'm not saying toughen up from a perspective of somebody who's not doing that with her own kids. In order for my 22-year-old son with Asperger's to be a 28-year-old who is responsible, I'm having to do that now. You've got a 28-year-old. In order for your 28-year-old to be responsible at 35, you've got to make some adjustments now. That may not be easy, but it's important.
I love the piece about saving for a down payment and returning that back to him. Creating a pathway to home ownership is huge there for your kid too. If your daughter is struggling to pay rent, guess what? Rent's going to go up. It's going to keep going up.
That's
if you can get a down payment on a house, even though it might be a sizable down payment, once you're in there, you've got a fixed payment, a fixed mortgage payment that's never going up. So a path to home ownership, a big piece of that too, Eric. Thanks for the question. Thanks for all of our questions today. You heard the final bell ring, so it's time for our final thoughts, Janet.
I would say, going back to just the Social Security, I think we've spent a lot of time on that today. Again, it is not a decision that is a $2,000 decision because that's what your monthly benefit looks like. It is a 6-figure decision. And it's so important to not just look at the 3 choices on the statement, but to look at that decision as a household decision and how does it impact everything else financially from now, meaning let's say you're getting to the point of retirement, from the point of retirement throughout the rest of your lifetime. This decision has an impact. So please remember, Social Security, the administration cannot give financial advice. You've got to sit with somebody who can give you financial advice and help you walk through that decision.
I'll use my final thought to go back to the fear factor that the one viewer had of the market, that every time it drops, He is worried about his investments. And at 60 years old, that's perfectly understandable. I know I'm talking today to a lot of people walking up near retirement and wondering, how are they going to stay in the market and tolerate that risk? You have to believe in equities, but you also have to believe in a diversified strategy that provides you income. Get a retirement income plan together before you retire. And we do that every day for our clients at GenWealth. We can start the Ready to Retire process with you. Just call us toll-free, 866-653-PLAN. That's 866-653-7526. And that is all the time we have for this week's show. Thanks for being with us. Thanks for the questions. Get some questions to us for next week's show. You can text or leave a voicemail to 501-3